Hi everyone, I welcome you all to our tech podcast series. And today we are back again with yet another podcast. Now, when it comes to our podcast, there are so many amazing things. We have entrepreneurs, we have some amazing people, amazing directors who actually come up with so amazing experience of technology. Now, today, to talk about amazing and the most trending topic and the industry is fintech. So to talk about that, we have an amazing speaker with us today. Our special guest is Nageen, who is the founder and CEO at Digitap.AI. So with that note, I would be very happy to welcome you, Nageen, in our today's podcast. How are you doing?
I am doing fine, Chavi, and thank you for having me on the podcast today.
That's amazing. So before getting started, would love to know that how you started your journey in this fintech industry, and also, uh, according to you, how is it changing the landscape of financial risk management?
Sure. Basically, as you've rightly mentioned in the introduction, that I am the CEO and founder of Digitap.AI. So we are a startup based out of Bangalore. We started Digitap back in February 2019. Sorry, in the month of November 2019, with the specific aim of providing a lot of API and SaaS-based solutions to companies in the banking and financial sector. Right. Specifically, we initially started off with providing them with solutions on onboarding, where we were helping them with digital onboarding solutions like Aadhaar KYCs or video KYCs and face liveness, face match solutions, OCRs, and validation of KYC documents and solutions like that. And we've initially onboarded one customer in March 2020, and after that, you all know, the lockdown happened and the businesses took a big hit. But post that, once the businesses started opening up after COVID, right, everybody had the same question in their mind in terms of, yes, we've been underwriting or we've been taking decisions in order to lend to a particular customer or not, predominantly based on their bureau scores up until now, right? But COVID specifically has changed that dynamics, right? A lot of people lost their jobs, a lot of people became unemployed, their salaries or incomes were cut down, and stuff like that happened, which obviously takes a lot of time to get reflected on the bureau scores and all that, right? So when we were closely working with a lot of companies in the BFSI sector, their main agenda or their main problem at that particular point in time was what additional sources of information were available for them to be able to underwrite risk in a much better way, right? Can they know whether the particular person with whom they are providing the loan, is he employed or not, right? How much income is he getting? Previously, he stated that he might be getting 1 lakh sort of an income, but is that right? Is that true, right? So there are a lot of data points that these companies or these lenders were actually looking out for to complement the bureau score that they already had about that particular customer, right? And that is when we thought of actually building out solutions specifically using alternate data points, to come up with scoring models that will help these clients to underwrite their customers in a much better way, right? So now, what has changed in the last three years or 2 years has been specifically in the underwriting side, right? Has been the use of data in terms of how savvy these clients have become in terms of using the data, understanding the data, and coming up with a straight through process, right? And when I say a straight through process, is basically not having any manual interventions, and then letting the machine or the data decide in terms of how I can underwrite this particular customer, how much to provide this customer as a credit in the first instance, right? So all these decisions started to be driven through data, and that is when these people became data savvy and they started looking out for the scoring models and alternate data-based solutions to help them understand their customer in a much better fashion, than just with the bureau score, right? So that is when, I think in the second half of 2020 is when we started pivoting ourselves and then building a lot of solutions around alternate data-based scoring models for risk management and underwriting as well, right? Yeah, so we've spent quite an amount of time building these solutions over a period of time. 2020 2021 were predominantly spent in building these solutions grounds up, and we've seen our revenue mix as well, right, change from say most of the revenue coming in from onboarding solutions back in 2020 to now where we get most of our revenues from the alternate data solutions, right? Specifically to talk about these alternate data-based solutions, we focus predominantly on 7 different data sources, right? Which are different from what a bureau data could provide. So we focus on bank statements that a particular customer can provide. We generate scoring models and variables out of that particular bank statement, which will help them in underwriting the customer. That's the first source of information. The second source of information is the data from the mobile device of the customer. The third source of information is the e-commerce spend that the customer is doing. Then we look at the telecom data, employment data, location data, and as well as any data which tells us as to how digitally savvy the customer is in terms of how much what sort of accounts does he have on the various social media platforms, what sort of presence does he have on the social media platforms, and in general in the online space, right? That also gives us an indication in terms of how risky the customer is, right? Just as an example, you could say that the more the person is active on social media platforms, the less risky the customer is, right? So yeah, there it's very easy to put it in a black and white sort of a space, but there are a lot of gray areas in that as well, and which is where we develop models using AI ML based logics to be able to come up with a score and provide the underwriting details, right? So now, what made the underwriting, or what made us different from say your traditional companies that were underwriting, right? Is purely the two three things, right? Is purely the sources of data that we've been able to generate, right? In terms of understanding the customers and how effective are our scoring models, right? Now having the data is just not enough. You need to make sense of that particular data towards an end goal, right? The end goal here is to obviously see how good the customer is, how better his repayments will be, how better his payments will be, and all that. So from that point of view, there are two things. One is obviously the complexity of the data, underlying data, and as well as how effective are the scoring models, right? But now, come 2022, 2023, we are seeing a lot of traction, especially on a lot of these traditional lenders and traditional NBFCs, banks, even to make sense of this alternate data, see how the alternate data can help them in terms of reducing their risk, and also reduce their NPS.
That was actually marvelous to hear that, and that's actually a great thing that you have been contributing to the industry since the few years. Now, moving to the next thing that would love to understand that when it comes to fintech, right? This is one thing that always comes out. What are some of the key advantages of using fintech in the financial risk management compared to the traditional methods that we have in the industry?
See, there are at a very high level, if you ask me, right, there are two advantages. In the traditional methods, right, mostly your lenders who run your large NBFCs and all used to take time in terms of assessing the customer, right? Now, what used to happen was that there used to be, I mean, you would be providing a lot of documents to these clients. They would do a manual review or a manual check of those documents, and on top of that they would also have the criteria of saying that, I would not disburse the loan unless I meet him in person, right? So the amount of time that used to be taken up in terms of just taking a decision whether I need to loan him or not was huge, right? And moreover, since there was a lot of manual effort involved, the cost of actually doing this was also quite high, right? Now, what fintechs like us have done is we've given them an alternate way of underwriting the customer. And so, what we are telling them is that, hey, you don't need to meet the customer in person every day or every time, right? 95 to 99% of the cases, you should be able to underwrite the customer using data, right? Provided your data models are strong, you have the right risk models in place, and all that. So that's the main thing that we are focusing on, and that is the thing that we've been telling a lot of these traditional players as well, is that you could cut your cost down and you could cut your time in terms of providing a loan as well down, by using data and by automating all these cases, right? Now, the advantage of having a low cost and a very less time in terms of taking these decisions is that you will be able to scale better. Previously, if you had to scale from a 1 lakh loans to say providing a 2 lakh loans in a month, it used to take you those many manpower to be able to do that. But now with technology and with this underwriting, data driven underwriting approach, you will be able to scale up from 1 lakh to 2 lakhs in no time, right? So that is the biggest advantage that we provide, is low cost and better time in terms of providing the loans. And the other advantage, of course, is basically the additional amount of information that you would have, right? For the customer, about the customer, right? Previously, even if you had like manual interventions happening, you might not have been able to know as to how active this customer is on social media platforms, or whether the mobile number actually belongs to that particular customer or not, right? He might be applying with a mobile number that he has taken on his friend's name, or on his with the intention of just throwing that number away, right? So there are a lot of cases, fraudulent cases as well, that we have seen where we, with the amount of data that we have, we've been able to catch those cases in a much efficient manner than what a traditional underwriting person would be able to do.
That's actually nice to hear that. And also, when it comes to the fintech companies, there's one thing which all the time come is how you actually like. There are so many challenges that comes into the picture. It can be in case of privacy, it can be in case of government, and so many other things, right? So, what are some of the challenges facing the adoption of fintech in financial risk management, and how can these be overcome?
See, there are I mean, obviously there will be challenges at every step of the way, and the role of an entrepreneur or a startup is to overcome those challenges and then build a successful business, right? So, but in general, if you ask me, right, there are two different types of challenges facing a fintech right now. One is completely on the regulatory or a compliance side, right? Now, RBI in the last year, in the year of 2022, has come up with a lot of regulations that has either curtailed some of the operations that these fintechs or NBFCs were in. I mean, an example of that was where they said that you cannot lend through a prepaid card, right? So that was a regulation that they came up with in the months of April, May, right? Which had a huge impact on a lot of these lenders who were actually providing credit on a prepaid card instrument, right? Then there was also a little more clarification that the RBI provided on the digital lending guidelines back in September last year, right? However, it still begs the question in terms of how much data they haven't addressed some of the questions like how much data can these fintechs be allowed to use, what sort of data can they use, for how long can they use this data, and things like that, right? They have given broad guidelines, but the guidelines around the usage of data and the amount of the usage of data and all that has not been made very clear by RBI in those guidelines as well, right? There have been instances where a lot of clients are still waiting for certain clarifications before they know that it is safe for them to use data from certain data sources, right? Now, having said all this, that's one of the challenges that we've been facing, where the regulator will every now and then will try to come up with certain rules and regulations which we will have to adhere to, and then it might impact certain solutions that we provide, it might not, but we need to keep an eye open on those cases, right? Now the second challenge is more to do with it's a lot more technical sort of a challenge, right? Wherein it's got to do with what sort of data is available out there, how structured is that particular data, and how easily can we make sense of that particular data and tie it to a use case like lending, right? Those are challenges that do exist. A lot of cases, you might have half-baked data, you might have data that you might thought will help you, but turned out that this data has absolutely no correlation with lending, right? So that challenge will always be there, especially when you are in the lookout for new data sources, right? You when you start, you never know how that data source will help or will enable or will curtail your lending processes. So that's a significant amount of challenge, but that's what we are here for. Those are the problems that we like to solve. And the final challenge, which I see should not be a challenge anymore, at least in the next 1 or 2 years, is that the acceptance of these data and these scoring models by the lenders in the industry, right? I see that changing quite a bit. Previously, there was a lot of reluctance in terms of using this particular data, either because they didn't trust the data that was out there, or they didn't feel that we had enough expertise in the market to make sense of that data, right? But now we've seen that changing. We've had a lot of clients come in and then say, hey, can we do something about this? We are open to working with players like you who provide database scoring models, and all that, right? But however, whatever we do in terms of assessing the data that is out there in the market and all that, we are absolutely clear in the fact that we do it only with the consent of the customer, right? So no data is ever taken out or done without the consent of the customer, or we actually do it by taking data from the publicly available sources, right? So those are the two key principles with which we work. I mean, that also keeps us in the right side of the regulation, because even when a regulator wants to take certain steps, we are sure that none of those practices that we have in place are against any regulation, right? We also watching the personal data protection bill that is about to come up in the parliament, and we are already taking steps, and we are already doing whatever we can in terms of adhering to whatever the bill is actually saying, right? So in terms of what sort of data can be taken, what sort of consent is needed from the customer, how the customer can revoke the consent, for how long should the consent be taken, for what purpose should the consent be taken. So we are already one step ahead in terms of dealing with these things, so that we know that when the regulations and when the bills are being passed, we are in compliance with them.
That was really insightful and great at the same time. Now, as we are talking about fintech, so right now we all know that one thing which is going on in the market is artificial intelligence and also data analytics. So, would love to hear some views from your side that what role do data analytics and artificial intelligence play in fintech-driven risk management? Because right now, like we know and we are also noticing that how artificial intelligence and data analysis is being a very vital it's playing a very vital role in all of the domains. So would love to know how is it going in fintech.
Yeah, so frankly, when we started off Digitap, right? So I'll give you a small example. When we started off Digitap, we were already having, or I was actually having a different a startup of my own, which was in the sports industry, right? And it was trying to personalize the experience of a sports fan on an online platform, right? And the way we were trying to personalize the experience was using a lot of personalization algorithms through the use of artificial intelligence or machine learning algorithms, right? Now, uh, unfortunately, that didn't work out, and then we were actually looking to see what best use cases are there for an AI slash ML led technology company, right? And immediately we landed upon finance or fintech as a space, right? Because we see huge potential for artificial intelligence and machine learning technologies to be adopted in the finance or a fintech space, frankly, right? Now, the one example that we have been able to crack is the lending example, right? Wherein we've been able to use AIML algorithms on the data sources that we were able to gather, and then make sense of that data and provide scoring models to help risk management and risk assessors to say that, hey, this particular customer is a less risky customer, this particular customer is a high risk one, right? Now, we see huge potential of these AIML models beyond lending in the fintech space itself, right? We see a lot of potential in terms of analyzing the data, or just the financial data of the customers, and try to come up with, say, cross sell upsell opportunities, right? Within the fintech space, and not just stick to lending, right? There are several use cases that we could look at in terms of, or the applications of AI or ML in terms of understanding or assessing, not just loan at the time of loan disbursals, but also at the time of loan monitoring, right? And then provide with certain early warning signals to our clients, saying, hey, this particular customer has taken a loan from you, but based on the continuous data that we have been receiving about his financial health, we feel that he might default on your loan this month, right? So it's not just being used for underwriting or risk management point of view, but it's also being used from a portfolio management as well. And also look at a complete 360-degree picture view of the financial health of the customer, and provide them with certain cross sell upsell opportunities, right? So that's where the game is moving towards in terms of AIML models and all that. Yeah, so I strongly believe that there is a huge potential for artificial intelligence and machine learning. And as you can see, the biggest proponent or the biggest use case for that right now is to decide, based on huge amounts of data that we have already gathered, uh, whether we can provide a loan to a particular customer or not. So that's, yeah.
That's actually great. And also, how do you see fintech continuing to transform financial risk management in the coming years?
See, it will play a huge role, at least in the next at least in the next few years, in the short term, right? Even the regulators have been proactive in terms of enabling the availability of data, so that so that the fintechs could actually come up with various models without the problem of dealing with non-availability of data and all that, right? Like, the account aggregator framework is a great example of that. So the regulator has mentioned that, you know what, if you guys want to deal a lot with data, then we will make it easier for you to get access to that data, and structured data, right? Rather than an unstructured data. So with the regulator push also coming in, we see that there is a huge scope wherein, probably in about 5 years time, you will see any lending company, right, disbursing a loan within 15 minutes. And the way they will be able to do that is only through the use of data, wherein they will be able to underwrite the customer in a 15 to 20-minute time frame, and irrespective of what type of loan it is, whether it is a securitized loan, unsecuritized loan, and things like that, right? And that's where I think AIML models, alternate database risk models, bureau based models, all will play a very key role in terms of assessing the customer that faster, right? And even the regulator is open to those models, right? Because the regulator is also saying, hey, here you go, take this structured data, and then you can build models on top of it, and that's how you'll be able to manage your risk better, right? So in my opinion, there is a huge potential as in the fintech space for data oriented approaches, something that we are currently doing. And as I told in my previous answers as well, right? It'll not just remain to lending, right? Or risk management. Once you have access to data of the customer, right, and the ability to churn out meaningful information out of that particular data, you will then see a lot of use cases coming out. As I told you, use cases like, what sort of how do I cross sell or an upsell to this particular customer, or how do I sell to him, do a personalized selling to him, right? Which is basically, that is something that only you want, but not as a generic want of a bunch of customers, right? So very personalized marketing will become a norm. Cross sell upsells will happen based on data and not based on just in general flooding of your mobile phone with random SMSs and all that, right? So that's where I think there is also a huge potential, specifically within the BFSI industry, for how the data could work.
That was amazing indeed. Now, before concluding this podcast, I would be very happy to like have an advice for all of our viewers that like how could what sort of advice we can get from you when it comes to the businesses and financial institutions who are actually looking to integrate fintech solutions into their risk management into their risk management. So, what could be the strategies that they could look up to, and how they can make some better solutions?
See, first of all, they'll need to be open to data-driven approach, right? So basically, a lot of people, a lot of my clients that have been keep meeting them for the last 1.5 year, right? They keep telling me that yeah, data is fine, but you know what? We've tried this approach, say 5 6 months ago, it didn't work out, right? So I think ideally, what people should be aware of is they need to first tie down the goal, uh, and then work backwards in terms of what data is needed to achieve that particular goal, right? Now, whether your goal is reducing your NPAs, or whether your goal is increasing your prepayments or payments on time, or whether your goal is finding out a customer who will be less risky, right? Now, in as is the case with any data driven approach, you need to understand the goal first, or you need to set your goal first and work backwards towards data, right? Otherwise, what will happen is, with the amount of data that is available, right, both structured, unstructured, and whatever it is very easy for a lot of these financial risk managers to get lost in data, right? Now, unless and until they define that use case and they define that end goal as to why they want to use this data, it is very difficult for them to say that just because data on mobile devices is available, just because data on telecom data of a customer is available, just because e-com data of a customer is available, right? It doesn't mean that you get all the data and then you don't know what to do with that data, right? So it's very important to first see what is the end result that you want to achieve with data, and then also look at how do you get the results from the underlying data to achieve that end goal, right? So these are the two key things that are very much needed, right? I can see a lot of inclination towards adopting these approaches, because even the traditional lenders have seen a lot of digital lenders coming up in the market and doing well just with the use of data, right? But having said that, those people need to come out of the mindset in terms of whether data will work or not, and then do take a step-by-step approach in terms of first identifying what is the end goal to use the data, and then identifying what data is needed to achieve that end goal, and then coming up with scoring models in terms of how they can bridge that particular gap, right, in terms of achieving that end goal with the data they have. And the second thing that I would advise is to have patience, right? Data driven models cannot be built overnight, right? Unlike your onboarding solutions, right? Wherein if you are onboarding it by sending a person and you are doing it in a branch, if you are onboarding a customer through that model, and then you could actually build a solution, a digitized solution overnight, and then say, hey, you can now onboard sitting at your home, right? You don't need to visit a branch. So onboarding can happen overnight. I mean, you don't need to wait in terms of seeing the results for an onboarding sort of a solution. But when it comes to financial risk management using fintechs or using data, right, you need to have a lot of patience. You need to make mistakes, frankly, right? And you need to learn from those mistakes, and only then you will be able to get that perfect model that will help you in terms of reducing your NPS for 3 to 5 years down the line. And the first 3 to 6 months will be extremely crucial in terms of having the patience and learning in terms of how to use the data that is coming out.
That was amazing indeed, and thank you so much, Nageen, for your amazing advices and for sharing the knowledge on fintech and risk management. I'm pretty much sure the listeners also loved it as well at the same time. And also, I've shared Nageen's socials in the description below. Don't forget to connect with him. And with that note, thank you so much, Nageen, for joining in. It was really great hosting you today.
Thank you, Chavi. Thank you for having me.
Thank you.